Hey, it's Max from UNFTR back again for the MeidasTouch Network here with an update about the U.S. labor market because affordability, well, it's kind of a thing right now.
The biggest thing is inflation. The second biggest thing is energy. Energy is way down. And what's also down? Gasoline. Also, the biggest thing is inflation, and it's way down. The reason I don't want to talk about affordability is because everybody knows that it's far less expensive under Trump than it was under sleepy Joe Biden.
Nope. Gasoline is not down. Crude oil prices are, but gasoline is flat. Inflation is above 3%, which is higher than the Fed's 2% target, higher than it was at the beginning of the year when he took office, and getting higher every month. So we know these are lies. But there's a flip side to the affordability equation. Inflation isn't always a problem if wages are keeping pace and or above, and if everyone has a job. So today we're looking at the flip side and digging into the labor economy because here's the thing about numbers. Unlike presidents, they don't lie, even when they're delayed. So we're going to review some available figures, then talk about methodology and what comes next in the U.S. economy. So let's get to it.
More than a quarter of the labor force now does gig jobs, says the Workers Lab at Johns Hopkins.
4-week moving average of private sector job creation in the ADP preliminary report down 11,000 on average over the 4 weeks.
The unemployment rate, it's barely 4%, less than the average of every decade since the 1960s. Yet two-thirds of U.S. workers now report living paycheck to paycheck.
Very low, near the lowest level ever since the 1970s, as worries begin to build about the consumer and the macro environment overall.
The functional unemployment rate is between 24 and 25% today, moving closer to 25%.
The financial markets and the mainstream news are finally waking up to the idea that the labor market might be FUBAR. Now, despite the awful nature of the subject matter, it's kind of amusing to watch. Now, one thing that temporarily spared both viewers and investors was the lack of data coming out of the government because of the shutdown. And because of the timing of it, the Trump administration was able to avoid not 1, but 2 months of crucial releases like jobs numbers and inflation data. And there's an argument to be made that the information going forward is going to be skewed because they have to play catch up. Now, there was plenty of private information available, though, and most of it was pretty terrible. So private payrolls show a weekly loss of 11,000 jobs on a 4-week trend. A couple of days ago, Challenger Gray and Christmas updated its number for October as well, and it was a bloodbath. U.S. firms announced more than 150,000 layoffs in October alone. That's up 175% from last October. Now, Challenger does a real-time report like this and a forecast, which we covered recently as well, showing that their survey respondents indicated the lowest projected seasonal hiring levels since 2009. Those seasonal hirings start right now. Or don't, I guess. So it's hard to imagine that the government survey of non-farm payroll is going to look any better once the machine is back up and running. And frankly, it doesn't really matter much. The revisions are getting larger and larger every single month because the quality of the survey data is degrading so precipitously. So we have problems inside the system. He's not wrong about that. He's wrong about a lot of things, though. So to the extent that revisions ultimately reconcile down the road with real-time information, there's an amazing chart that illustrates how timely the government shutdown was for Trump. So the chart that you're about to see is something called the Beveridge curve. The shaded beige curve is the ratio of job openings to the unemployed. So when this trend dips below the dotted gray line, or when it generally declines for an extended period of time, it always, never not, it always precedes a technical recession. So you can see from the chart that the Beveridge curve was already in steep decline prior to this year, but that was a reflection of the chaotic supply and demand issue post-COVID. The curve started to flatten out just a little bit toward the end of Biden's term, but then again in recent months, it started to decline again. And just as it was about to dip below the holy shit threshold, that gray dotted line, the data stops cold as of August. So because this is built upon non-farm payroll data from the BLS, it hasn't been updated since the end of summer. It's a matter of temporary convenience for the Trump administration that won't last very long. And quite frankly, again, it doesn't matter. more and more citizens, including those who believed in Trump, are confronting the reality that he has no idea what he's doing. The labor market is the engine of the U.S. economy, and it is seizing up and coming to a grinding halt. So I do want to review methodology quickly before we talk about kind of what comes next in the economy and what the next administration is going to have to do in order to get the U.S. labor market back on its feet. But one of the big things that we have to acknowledge, but not get lost in right now, is the impact that AI is having on the labor market. So right now, that's like the big narrative. AI is already causing massive job loss and the apocalypse is nigh. Personally, I fall somewhere in the middle camp, somewhere between AI boosters and naysayers when it comes to the potential impact of AI on the job market. But on the surface, I do think it's fair to say that there are areas of the labor market that have definitely already been impacted, like the creative market, for example. But a lot of those jobs, a lot of those that have been impacted by the surge in copywriting and design productivity, and to a degree, coders and programmers, they were already part of the gig economy or the offshore economy, and they weren't really factored, believe it or not, into the larger data picture of full-time employees. Now, there have definitely been productivity gains, and we're seeing that play out in the numbers as well, but I think we're only at the very, very beginning stages of what's possible in terms of large-scale job displacement. And here's the other thing. Again, this is directly from Challenger Gray and Christmas data. Of the more than 1 million job cuts through October of this year, 1 million, only 48,000 were specifically cited as due to AI. And most of those were in the tech sector. The rest of the cuts came from across the board and in sectors where AI may never be a factor. So the point here is that of the job losses that have been expressed, it's only 4 to 5% of those. I'm not saying that's not big. I'm saying it's an overblown narrative for the actual impact. And that if you look at the real job cuts that have happened this year, this is part of a much broader and steeper trend that already exists. So to benchmark it, let's talk about methodology so we're all talking about the same numbers. Now, we've covered some of this before, but I think there are some visuals that will drive it home. For example, this is a look at the total U.S. population. Growth has begun to slow in 2025, though it's barely discernible yet. This is due to Trump's mass deportation policy and the much talked about decline in birth rates, which is really an economic factor, but that's also for another day. Now, this is a graph of the U.S. population between the ages of 25 and 54. Right now, this cohort is around 130 million people, but we want to focus on the trend line. You'll notice a slight uptick in the last couple of years with Gen Z and younger millennials entering this important labor demo. But the broader trend line, again, is flattening compared to prior decades because boomers are aging out of it. So this is important because this demographic is the driver of the workforce, and it's the one that economists actually care about the most. We're typically fed the most garbage statistic of all, which is the unemployment rate. Today, around 4.3%, or at least it was as of the government shutdown, and it won't be updated for a while now that things are opening up. But this is a measure of survey respondents who indicated that they've worked, get this, at least one paid hour in the reference week. So respondents who say that they did not, but they're actively seeking work within the last 4 weeks are considered unemployed. If they've gone longer than that, whether they're looking or not, they drop out of the data. So think about how bogus that number is. And that's why economists ignore it, and so should you. What matters to economists and to policymakers is the prime age labor participation rate, which measures the employment rate of those in the 25 to 54 cohort. So let's look at this chart together to uncover some nuance. The colored lines below the gray horizontal line speak to the size of the labor force, and it distinguishes between active and inactive. Fine. These are absolute figures in terms of numbers. But if we look at the gray line, we can start to build a narrative. The blue line above it is the total participation rate, which I'll explain in a second. The green line is that prime age participation rate, that 25 to 54 demographic. So now this is drawn directly from the same BLS data that goes through filters and revisions and ultimately winds up at some point as an accurate representation of the working population, though I'll offer a caveat to that as well in a second. What I want to focus on is the increasing spread toward the end of the graph. What this reflects is a decline of the total number of people in the country who are working versus the percentage in that 25 to 54 cohort. All right, so a few takeaways. As a percentage, the total participation rate is around 62%, but it's been declining for decades. But the prime age rate is still very high. It's around 83%. That's the one that the so-called market follows. It's built into every hedge fund, every money market, every asset manager analysis. It's also the one that economists and policymakers care about because these are the productive years of the population. But if we go back to the demographic chart, remember that this cohort is flattening out. So as a percentage of the whole, this age group is less than it used to be. Now again, that's because of the boomer exodus. 10,000 baby boomers every single day are leaving this cohort. But there's also pressure building up on the other side. It's like the trash compactor in Star Wars, just pushing this group to the middle. Young people are finding it harder and harder to find good paying jobs after high school or after college. Youth unemployment is up dramatically. And boomers aren't just leaving the demographic, they're leaving the workforce and they're retiring like never before. Now, a couple of other important notes. Even total participation doesn't include anyone under the age of 18 because they're not supposed to be of working age no matter how many Republicans try to eradicate child labor laws. So that's also 22% of the population that lives off of the middle, now supporting kids and parents out of the workforce. And by the way, if you work in the gig economy, you're included in those full-time employment figures as well. Even if you're outside of the gig economy and you work a full-time job but still qualify for SNAP benefits and Medicaid, you're included in the numbers. So even a productive middle of this high unemployment percentage of 25 to 54-year-olds doesn't really tell the whole story. This is what tells the story.
We have two economies today. We have one that is intensely market-driven for those at the top, which is extraordinary. They are spending like there's no tomorrow. Meanwhile, for those at the bottom, they're not sure how they're going to make it through the day. Those at the bottom have an intense awareness of what's going on above. But I don't think those above really appreciate the despair at the bottom.
Do you see how they talk about this in such revelatory tones, like they're unearthing some great mystery of the universe? That's how disconnected the financial markets and the pundit class are from what's really going on in the working class. The reason the market can continue to rock and roll, that corporations can report solid earnings and big tech can inflate this AI capital bubble with hundreds of billions of dollars is because the top of the K-shaped economy, the top 10%, is killing it like never before. Even before this Trump administration, the top 10% of the country is responsible for 50% of the consumer spending, and that gap is just widening now. So we don't need the government to come back online and start spewing out BS data to know which way the wind is blowing. But had that data been flowing, we would already see that this economy is toast. The omniscient and omnipotent markets are always the last ones to face the music because the collective conventional sentiment of bull markets is that they'll never end. But they always do. Always. So when Project 2025 was released, I did an exhaustive piece on it on UNFTR and said back then that if Trump was reelected, it would be less than a year for him to utterly destroy the economy. And that's not a flex. I'm not patting myself on the back. I'm just decent at math. Actually, I suck at math. I'm just pragmatic. We have been living in a cheap and easy money environment in an economy that's built on services and financials. Remember, manufacturing is only 10% of this economy. The biggest employment sectors are healthcare, government, education, and business services. So while they contribute to GDP and therefore to productivity, these are inherently capital-sucking sectors. Cheap and easy money has inflated these sectors, and we look elsewhere to exploit manufacturing labor, which is really the driver of a truly productive economy. So this is the trajectory of every hegemonic capitalist empire as modeled by economists like Giovanni Arrighi, who observed that mature capitalist economies move from manufacturing to services to financialization before decline. And we're in that last phase, that financialization phase. Project 2025, and therefore every move made by this administration, just logically speaking, was designed to increase the cost of goods and services through tariffs, to destabilize the labor market, mass deportation, to punish the poor and the working class, eliminate subsidies and increase work requirements, to inflate the accounts of the wealthy, tax cuts and deregulation. The chickens are just coming home to roost. And yeah, it took less than a year. So here's what happens next. The market will go through wild fluctuations between now and January. So reality is going to push the stock market down, and the slightest bit of positive information will cause it to rally in dramatic fashion, just like 1929. In other words, a lot of volatility, so watch the VIX. The uber wealthy will have a field day during this period because they'll make huge bets on the swings with options and puts and shorts, and some of them are going to win very, very big. The consumer, on the other hand, will go into even more staggering debt to pay for the holidays, and then come January, this is all coming tumbling down. Even for the bigwigs, because reporting will have caught up by then, and there will be no hiding from the data. And then the Fed will step in with what they call the Fed put, more money coming into the economy. And I want you to bookmark this, put it on your calendar for the end of January so you can check back in. Now here is what comes next. The next administration, and yes, I'm looking that far down the road, will have to recognize first and foremost that we are in the end stages of a total paradigm shift. Old thinking will no longer do because, again, as much as this is a critique of the Trump administration's complete mishandling of the economy, it's also an acknowledgement that he's mishandling it by throwing gasoline on an already burning building. Now, we launched something at the beginning of this year called the 5 non-negotiables in anticipation of all of this. It's a policy framework of must-haves for the evolution of the economy, knowing that he would be the one to put the nail in its coffin. So it's a framework to deal with housing, healthcare, the environment, election integrity, and the labor market. I'll leave a link to it in the description if you're curious about it. But the pertinent part for today is that to deal with labor, we have to invent new things. We have to think about something that we're calling at least a civilian labor corps. We have to put people to work in areas of the economy that are being ignored because the free market doesn't find a profit motive in them. So, give you an example. We're going to need caretakers for our elders. We'll need strong young people to help us with climate resiliency projects. We'll need 1 million young Jimmy Carters swinging the hammer to build affordable housing. The list goes on. Now, some of this is admittedly depression-style gritty thinking. Some of it is looking at what other mature economies with aging populations have managed to accomplish. All of it is a reflection of a humanistic attitude towards solving economic problems, basically the exact opposite of what they're doing now. So I'm looking to you, the Midas Mighty. Presumably you exist somewhere along the spectrum from democratic socialism to blue dog Democrat. You might even be a liberal, curious conservative. The message here is to batten down the hatches because this GOP despises the working class, and they've devised a plan to destroy it because they find it loathsome. They do not like, nor do they respect labor. They're just a path to votes. They're not constituents to serve. And so they will lose them. As sure as they're about to destroy this economy, they will destroy their base of support. It's happened before. But when that base looks for solutions, they can't find a bunch of glib corporatists in fancy suits with flashy smiles. They have to see authentic, hard-scrabbled defenders of the working class and hear ideas that speak to them, not at them. For the MeidasTouch Network, I'm Max from UNFTR. Don't forget to visit UNFTR.com to sign up for our free weekly newsletter, and you can find me on Blue Sky and YouTube at UNFTR. Thanks as always to the Meidas Mighty for having me here, and I'll see you online.
Love this video? Support independent media and unlock exclusive content, ad-free videos, and custom emojis by becoming a paid member of our YouTube channel today. You can also gift memberships to others. Let's keep growing together.